Today is May 11th, 3:13 p.m. and Canopy Growth is now trading at $1 minus 14% today. Ticker symbol CGC. Has it bottomed? In this video, we are going to analyze these unusual options activity we detected today to answer that question. And for context, let's take a look at when was the last time CGC was trading at $1. So we zoom out and try to find that. Actually, we'll probably go to let's go to the 3-year weeklies. Okay, so in the past 3 years, this is still the low. Let's go back 10 years for the monthlies. And there we have it. At over here, this was the low back in 2015, August 2015. It was trading at $1. So we are all the way back here again. And you'll see this if you look at the charts. Make sure you change your charts to the 10-year charts. So has it bottomed? Because it hasn't gone below that $1. And so technically it looks like it could have bottomed, but let's see what the unusual options are telling us. So when we look at these high volume trades today, you'll see this around this 1250, 1248, there were these 2.5 strike puts and 2.5 strike calls, 5,000 each, total of 10,000. Okay, and these were all done together as a spread, you'll see here. And when we look at the chain, you'll see here this 10,000 over here on the call side, 2.5. Definitely open orders since it's greater than the open interest. There were only 9 that were open prior. And same over here on the put side, there were only 98. And so today, 10,000 in the volume on the 2.5 puts. So what does this mean? Is this bullish or bearish? So that is something we're going to analyze. So because it can make a big difference. If this was bearish, they could have bought the 2.5 puts and sold the 2.5 calls, and then this would be a bearish synthetic trade. You'll see this because this price here at this current price, as it goes down in price, this is the zero profit loss line. This profit will increase. You'll see that line is above this zero line. So the price is on the x-axis. And so as it goes down in price, it will increase. So this is a synthetic short. And if it goes up, it will lose money since it is below now this zero line on the profit loss. Now, however, if they had bought the 2.5 calls and sold the 2.5 puts, this would be what it looks like. It would be a synthetic long stock. Price here, price goes up on the x-axis, profits go up as you see here. Same if it goes down in price, it will lose. So it's very important to determine what was the trade. Was this a buy or a sell on the call? And on the put, was it a buy or a sell? So to figure that out, let's dive into these options more in detail. And the way we could do that is by going to the, we close off this options time and sales here. And let's take a look at this over here, product depth. Okay, we'll take a look at the product depth. And over here, we're going to just look at the Junes when these where these strikes were. And so when we look at the Junes, you'll see here this is the call side here. You see the call we're looking at the implied volatility here. This is the puts. So when we look at the 2.5 strike price over here, you'll see right away that the implied volatility for the call side is about here, a little bit below 200%, right? And over here on the 2.5 strike price, we're above 200%. You'll see that here. And so what does that tell us? That is telling us that the most likely sale or buy is happening at the put side. The sale is happening at the put side because you want to sell at higher volatility and buy at lower volatility. So selling the put, buying the call is what it looks like based on the implied volatility. So, and if that's the case, as we had shown earlier, if you sell this and you buy this, then this is then essentially a bullish trade. And so this is why we think CGC has bottomed, that this very large trade was put on because there is this belief that it has bottomed, and also technically, since the last time it had bottomed to $1 and never went below that was in 2015, as we showed over here. And so the way we're trading this is we are simply just buying a one strike call here over at the June's, the same expiration date for the June 16th, expiring 36 days away. Okay, and so you can also keep in mind that earnings is also coming up. This is May 30 before the market, and so this is the chart, what it looks like here as we look at Canopy Growth when it last bottomed here. Okay, and so we think from here on it should come up. We don't know how much up, but if it looks something like this, that would be very nice for a bullish trade, or like this, anything above $1. You'll see here there is a break even. If you have if you buy a call like this, the break even is actually at expirations of 1.15. So it has to be more than $1 to be breaking even at a profit, because we had to pay, currently going for $15 per contract, option contract here. Okay, the theta is very minimal. That's why we're able to take on this trade, because it's so minimal, because it costs so little that there's not much to decay. And so because the price is so small, that yeah, there's not much. And so yeah, if this was helpful and you enjoyed this video, please smash that like button, and please comment below on what you think about Canopy Growth. Has it bottomed? Will it break that to the 2015 low of $1? And so that's something we really want to know based on our analysis today. Tell us what you think on the comments below. Subscribe if you haven't, and smash that like button. Thank you, and take care, everyone.